The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Good morning, everybody. It's not Larry Pesavento. It's Tommy O'Brien filling in for Larry, and we have a treat. We got our man Basil Chapman filling in as well this morning. Basil, good Monday morning.
Good morning to you. Quite a very energetic morning we've had here, but I think we've got everything going. How are you?
I'm doing fantastic, man. How is lovely Boston doing this morning with the weather?
We had just 2 beautiful days, and yes, the 3rd day, just absolutely perfect. But this is where you want to bottle it and then open the bottle on January the 6th.
Savor it all, right? Savor it all for sure. So jumping right into things, folks, we got a negative market to start things off. Right now, you get the Dow futures off about 133 points. You have the S&P futures off about 15 points. You have NASDAQ futures off about 45. All of those in the range of about negative 0.5% to 0.6% in the negative. The story and the headlines this morning in terms of what is reverberating. You got protests going on in China, in Hong Kong, and quite a scene there in terms of all flights being shut down, that reverberating in terms of trade concerns, of course, with those Hong Kong protests, in terms of U.S., China, so forth, reverberating as we're all kind of familiar with this. And keeping with that, Goldman Sachs cutting growth forecasts, not to be dismissed as trade war triggers recession fears. So you have Goldman Sachs lowering its 4th quarter growth forecast by 20 basis points to 1.8%, citing a larger than expected impact of recent trade war events. So lots going on over here, Basil. Taking a look at the VIX as I did in the top of the hour update. You have a VIX this morning trading at 1947. We got a spike, of course, to 2481 last week when the market was really cascading. And I'm just going to pull up real briefly for a little bit of context in terms of last week, where we went. Just taking a look at the SPY, and I'm going to put it real quickly on about a 10-day, 30-minute to kind of illustrate in terms of where we went when you ended on August 2nd, which is now a week and a few days, in terms of we ended at about 292. Pretty remarkable that you have the SPY trade down to 277 last week. You trade back and finish within 1 point of where we started the week. But nonetheless, we start the week on a negative note, 290, but pretty remarkable the flush that we had to negative action last week. The market almost completely rebounding from that low. And this week, though, trade concerns at the forefront as they were last week as well. So, Basil, what do you have on your radar this morning? I know we don't have your camera this morning, folks. Basil, he's been fighting through. He's a trooper. He's got his computer up, but we don't have his camera. We got his voice. That's all that matters. Basil, what do you have on your radar as we hit Monday morning and we see negative action in the markets once again?
So there are a couple of things that are really important to me. Now, I'm not sure if you actually are seeing my camera. Are you able to do that?
We can, Basil. I'll try and do my best. What's going on is we have all 4 screens at once, but I will try and put perfect. I have your chart. We'll be able to set it up.
Okay. I wanted to show something that to me is really important, and that is within the context of my weekly charts, and let's just stick with the Dow and the S&P for the moment.
Okay, and we do, Basil, just so they're going to be able to see it. I have your Dow chart up there. We're looking at all 3 of them on all time frames, so go for it.
Okay. So on the left is the daily chart. This is the futures. I want you to show you the futures because they're down 147. But I am going to go to the Dow itself as it closed on Friday, and I'll tell you what I was looking at for the weekend. For my subscribers, what I said, we're remaining short the Dow, and one of the reasons is within the context of my weekly charts, this what we call peak E in the Chapman wave. In other words, I always look for at least 4 higher peaks, but when you get this arch formation where we went to a peak C from the low that was made back in December at 21,712 all the way to 26,695, and that was in April, and then it turned down sharply to 24,701. This is the Dow. This move up eventually got to that leg D, but then there was a modest leg E to the upside to the all-time high of 27,398, followed by a little doji candle and a big red candle. To me, that said, be very careful, because if the stochastic starts to decline sharply and the MACD makes this M formation, like the letter M, and the right side of the M starts to fail, I could get a sell signal. So everything about the chart said the MACD crossed just slightly negative at the close on Friday. The stochastic was still pretty good at 83%. The price dropped very sharply, having gone from 27,398 to 25,440, but it closed under the black line, that 14-period moving average and the 9-period moving average. Everything there said I should put in a down arrow for at least a sell signal, but because the stochastic was still at 83% and the MACD had just barely crossed positive, I said to subscribers, I'm holding off for a little bit, but if there is strong weakness early in the week, I'm pretty sure that I'm going to have to go to at least a sell signal. Sell signal is as deep as the connotation when I say sell mode. The Dow daily is in a sell mode.
Okay.
This is just starting to turn down. So for me, the Sunday night open, I had a technical indicator that said there should be a 9 to 11 point rally within the coming two sessions after Friday's close. Well, we actually got a pretty sharp rally early on as the market opened last night. And then there was the turn down. So it's kind of fulfilled everything. So to me, this is really important, because the pattern I'm looking at says in the Dow, and I'll show you the S&P. The S&P is the same thing. Look at this turn down the S&P weekly at a peak E. And the stochastic is at 85%, still good, but the MACD just turned down. This is really important. Everything about it visually, when I'm looking at this chart, I'm saying, uh-oh, this is a problem, because the rally, the comeback that we saw from the low of last week at 20, what was that, 28, I think 17, let me just check. It was at 28, 28, I think 22. That rally is really important for it to continue this weekend. You want to see the S&P up in the 2948, 2958 area. Then I think you've got something different. But right now, I'm kind of cautious on the shorter term, because this weekly chart is so important. I just want to spend a little time saying, based on my work, what happened at the close on Friday when you came back quite so strongly and then closed weak and the S&P itself was very weak, it says I'm still kind of cautious right now. So I just wanted to get that to show on a technical basis. This is what I'm looking for. And an S&P closed this week below 2885 would say, uh-oh, that's a real problem. But if it goes sideways, I don't mind the sideways consolidation. I just thought I'd clarify.
No, that's great. And that's why I kind of took a quick peek at the SPY just for some context in terms of where we were last week, because you hear, the markets are down about 0.5% as we just await the opening bell. And I got that chart back up there, man, and just mammoth move last week. So yeah, we were down a bit, but boy, you better watch out, because these moves to the downside, folks. I mean, that SPY move down to 277, and before you know it, by the end of the week, we erase all the losses. Not like you can just forget that type of action, and then especially, I'll pull up after the break some of the images of that Hong Kong airport. Hopefully that does not escalate for sure. Stay tuned, folks. We're coming right back.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Welcome back, folks. Tommy O'Brien filling in for Larry Pesavento this morning with our man Basil Chapman as well. Larry going to be back tomorrow morning. We'll try and hold down that chair for him while he's away. So jumping over Basil, I just had some visuals. I'm not sure if you have my den chart. Pretty remarkable stuff over here, folks, in terms of the Hong Kong protests. They just continue. And these people, they're fighting for their rights over there. And the worry, of course, is the escalation that seems to be continuing in terms of police crackdown, in terms of how that would play into the trade negotiations between the U.S. and China if anything were to escalate. Hopefully it does not, but when you start shutting down airports for days at a time, that is the worry on the market, and we got the image up there. I mean, just serious stuff. So hopefully, I mean, you've heard Larry talk about that. Larry, it's his program. So he spent some time over there in China, familiar with Hong Kong, and his personal experience is talking about the people he knows. It is pretty intense over there right now, and that's what you're seeing reverberate in the market. And realistically, not that big of a move in the market if you really think about the effect that could have if, God forbid, something really bad happened in terms of a crackdown on those protesters and how that would play into any type of trade concern, let alone just the lives that are over there. So we'll see how that plays out, but all flights shut down over in that airport for Monday, and it seems like they're talking about that airport's going to open back up on Tuesday morning. But we'll see what happens as that market reacts, and the future's down about 0.5% coming into the day. So Basil, we got some earnings this week. I was looking at Walmart coming down the line, I believe, Thursday. Quite a number.
This is very interesting because Walmart has had a really, really strong move. In fact, when you think of retail and you think about what Amazon has done to so many of the smaller retailers, it is really impressive to look at the Walmart chart and say that the high that was made back, let me just go, this was, I think, January, was it December? No, it was January of 2018, makes a high of, that's interesting, Now, why is that? When you change over a system, you get a new computer. There's a very big learning curve. And I'm trying to find out why I'm not getting the price.
Basil, exactly.
Right.
Let alone if you do a live show program with charts.
It's 110 was the high back in January 2018, and it made another high, and that was at about 115 back in July, I believe it was.
Yes, just last month. Yeah.
And now it's just at 107, 106. Pretty darn good when you think what the challenge of these huge retailers to be able to compete against an Amazon, which is cutting edge technology, cutting edge everything. So I've been very impressed with the move. I think right now a digestive phase, peak D in the weekly chart. I wouldn't be surprised if it trades between about 102 and 110 for the next couple of weeks, maybe even test the 100 level. But so far, over the year, it's been fabulous, really outstanding.
I would agree. And, I'm not a big Walmart shopper myself. I love Amazon. But for the first time in about the last, I'd say, 6 to 12 months, you've really started to hear the fundamental story of Walmart, whether they're starting to approach free 2-day delivery on items, whether they're starting to implement that process of free 1-day delivery even as they really start to compete. I mean, that's where Amazon has had that, stranglehold on the market in terms of free 2-day delivery. That's what allowed them in the early days of, we'll call it the early days of the internet, but really early days of retail domination of the internet by Amazon, is that they had perfected 2-day free delivery. People didn't want to go pay for a pair of shoes on the internet that they then had to pay an extra $15 to get delivered, right? So Amazon perfects that. Walmart, they've been saying they got a chance to compete with them because they are the juggernaut, a $500, $600 billion company with the cash flow that could really come in and compete, and it looks like that they are. I agree that, it's almost to the point, Basil, where I will feel comfortable price shopping an item on Amazon to Walmart because they'd have a similar delivery function, similar delivery cost. And I think if Walmart ever achieves that completely, right, where everybody is familiar that if you're going to buy something on Amazon, Walmart's going to be able to offer the same product, so you would check it, you'd price check it, and they'd be able to deliver that product in a similar time frame for a similar cost, boy, that would be just mammoth to have a competitor on like that. Because right now, I think we'd all agree that Amazon is the giant in the room, and they are almost the monopoly in terms of how they deliver items. I mean, I had an item delivered yesterday. I think all of us, if you're an Amazon customer, get 1-2 items a week, whether it's a month. They have the automatic. You sign up for things, they get delivered on the regular now. So I would agree that I'm almost at that point that you begin to price shop on Walmart because they offer that same delivery service. And if they get there, man, you're going to see some growth because the numbers have been staggering in terms of the growth that they put up. And that's why we'll see this week when they come out with their numbers again in terms of what type of online growth. That's probably what the market's really going to be looking for. What is their online growth? Because they're looking for big numbers on that online growth sector as they come in. And yeah, I see that chart on Amazon, man, right near those highs.
But have a look, Tommy. Look at the same peak that was made in the daily chart, the same pattern as Walmart. The same weekly pattern coming down sharply, and also off the high, off the all-time high, just like it very similar. Let me just keep your eye on both on 3 charts. Here we go. I'm going back to Walmart.
Yep.
And look at this. WMT. Here we go. There it is. Look, you had your peak right here. You got your sharp daily decline. You've got your weekly decline, a little bit of a decline. And then the weekly and the monthly made it slightly new all-time high, just like Amazon, and is pulling back. I'm actually surprised. Thank you for pointing that out, that the similarity between the 2 charts.
Yeah.
It's very interesting,
and
yes.
You really see, I'd say, that they, once they achieve, and they're so close to just complete domination between the 2 of them, right, in terms of retail, that if you start to see a slowdown in the economy, both of those charts are really going to react to that, because when you see a slowdown in GDP, you talk about Amazon, you talk about Walmart. If that economy slows down across the country, they're going to feel it. And so they're going to react to those economy woes, those trade concern woes, when you're delivering so many products to the American consumer on a consistent basis, that you could see some similarities. Like we said, especially when Walmart, they've really done a great job of, and I don't know how you do it, man, to be in that war room, right? And they have the funds, they have the cash flow, so they do. But man,
there's no room for error.
That's quite a task to sit in that boardroom and say, how do we compete with Amazon when they were starting from a position of inferiority, which is remarkable that Walmart could allow a company like Amazon to, cement themselves as the number one. But Amazon is built for retail. They're built for warehouses and delivery, whereas Walmart, Amazon is built for delivery. Walmart is built for retail, as in having so many stores, so they've kind of had to catch up to that system, but it seems like they might, and we'll get those numbers on Thursday. And that should be interesting, man, in terms of how we react and in terms of how we react with the market as we're seeing, some potential slowdowns as we come across. And I know you got the Dow up there, and you can see how they're reacting as well.
So what I thought I'd like to do, since Larry is always talking about the futures, if we could just run a couple of things right now, just so that we can update, because this is going to be a very important.
I like it. Let's do it. Perfect.
So we've got the Dow futures down 153, and you can see this thin wick candle of last week. It's so important that if in the futures, if there is a close, even a close, it just has to slide to 25,800, and that's going to be pretty serious in the Dow futures. And the E-mini, ES right now is down. Oh, why am I going to get used to this?
That's all right, Basil. I tell you what, we'll pause there. It's perfect because, man, that formation last week, and that's why I pulled it up at the top of the hour. I mean, you'd almost think nothing happened last week, folks, if you looked at the opening price and the closing price. But, man, that tail end of that chart. We're going to check it out. We're going to go through those futures, and we come right back, folks. Stay tuned.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Folks, welcome back. I'm Tommy O'Brien, joined by Basil Chapman this morning, filling in, holding down the chair for Mr. Larry Pesavento. And so, Basil, we were jumping around a bit. I see you got the dollar up there. Where would you like? Where were we finishing off that conversation?
So a couple of things. The dollar has held very well considering what gold has done.
Yes.
How long it does that, I'm not sure, but I still consider that gold is like, I call it the Harley Davidson of currencies. It's not the company of Harley Davidson, but the icon of Harley Davidson. I think it's still representing what is good about our economy, and therefore most countries are still favoring the dollar. That's what it looks like. That's why it's held so well. That's why it's run from the 88s back in February of 2018 all the way to the 68 high that was made on the 1st of August, and now it's consolidating. So to me, this is really important, but it is leg D in the monthly chart, so we have to watch it closely. If the dollar starts to trade under 96 in the next week or two, that's going to be a problem. But look how interesting the sustaining power of gold has been. Let me just get there right now.
It really has. I mean, I agree, man. You know, Tom and I talk about it in terms of course, he's got the gold report. Just incredible how gold has done with how strong the dollar has been.
Well, I've spoken about this for some time, and I think I'm still in the camp that says you've got to separate gold as a currency of fear. This is just my impression of what's going on. You've got to have the dollar as a stability, let's call it a stability icon at the moment. And you've got to think of interest rates as something completely different. It is an international race to the lower yields. They've been forced to do that. And that is really why this particular sell-off that we're looking at in the market right now is going to be very important to see how support holds and how long the consolidation lasts. Because at this particular point, what is everybody going to chase the bonds, the TLT, trading at this particular point, 141.60?
We got a 1.6 handle on the 10-year right now, Basil, exactly, for sure. Right?
Yeah, and if you go back to the monthly chart, there was a high of 143.62 in July of 2018. It dropped down to 111.90. I mean, 143 to 111 for anything, let alone bonds.
Yes.
I mean, that's a pretty big move. And then to screen back in an even shorter time, back to the previous high, something's going on here that we just cannot, you just can't dismiss it and say business as usual. I think this is not business as usual. Something's going on. And normally, I used to have this, it's gone. I used to have this expression, there it is, low rates force TINA, T-I-N-A. There is no alternative, and that's the reason I think why very quietly the market has been holding very, very well, because when you think about it, what are you going to put your money into? Real estate at this particular time, unless you really understand it, or unless you have to buy a place, you know, as a spec investment, thinking you're going to double your money, I think that's tough to think of at this particular moment.
Yeah. And the one thing, too, just to tie it in, just like you're saying, so you saw gold really spike higher last week as the market cascaded lower early in the week. But what was interesting is that and just like you're talking about fear, right? So you had the market falling apart, and you had gold really start to spiked above 1,500 for the first time in a long time, as you had the market really cascading to the downside. But then as that market rebounded last week, you didn't see that same pullback in gold, which, you know, maybe there's still that fear out there, even though you have the market pulling back, which would make sense, folks. You know, you got the Dow down 1,000-point swings in a day. That fear is not out of the market. That's why I almost snicker to myself, you know, as, you know, the S&P, the SPY goes from 292 to 277 back to 292, and somehow we're supposed to forget about the SPY moving 15 points down and up in a week, as in that fear could still be in that market, and maybe that's something that's reflecting itself in gold as you saw the spike on the market pullback, and then the market rebounds, but gold says, you know what? No, we're not going to pull back. We're going to stay above 1,500 for the time being, which is interesting, and how that plays into the whole correlation of everything.
So on a purely technical level, on the left side chart, the daily chart, you can see how, I always say, a rectangle formation can last a lot longer than your patience. When you go from the 25th of May at 1455 in gold down to 1384 just about 6 days later, and then you stay within range with one little pop to the 1467 level and back in the range, this move now essentially starts another little rectangle formation at a higher level. I call it a high-level consolidation. And you're absolutely correct. When there was an amelioration of market fear, when you saw the markets spiral back again rather than stay at the lower levels, down at the Dow, it would be, say, 26,000 to 25,800. Sure. Gold just hang in and say, you know what, we gave you a chance. We're still thinking there's a lot of international geopolitical concern.
Right.
And I think this is a big reason why you've got gold, because if you look at silver's almost been dragged up. It's done very nicely. I'm just saying that if you look at the charts, it looks like silver's been dragged up because gold is leading.
Yes.
But if the two go together, that's just telling you that something's happening in these in the area of safety.
I would agree.
And people are perceiving that this is another way to look at markets and to have some insurance rather than maybe buy the VIX. You buy gold, in this case, you buy some silver. So perhaps that's the reason why you've got this high-level consolidation. Now, silver's getting very close to the weekly. I can't believe I'm saying this. 17.36 is the silver continuous contract, leg D. We're so close to it now with the high just 4 days ago, just underneath that 200-period moving average. And normally, as you're approaching it, that's when you start to see resistance. So that makes, I can't answer Kathy now. Let me just tell her.
It's a busy Monday morning, Basil. Lots going on out there.
That's important. And I just wanted to say that the euro, if you look at the euro-dollar currency pair, why am I typing it over there? Oh, I'm going to have to get used to a lot of things going on here. EUR, USD. Euro is rallying a little bit now. It's not showing tremendous signs of strength, but it is showing that it's holding very well. The euro is 1.212. It is up 0.001. So it's holding very nicely. And if you look at the USD JPY, which is the yen is down sharply. It's down to 105.19. It is actually now lower than it was at the low of January of 2019. Right there, if I can get it, at 105.18. We're now at, we've already gone below that today. So a full arch formation, a full circle from the low of January all the way up to 112, back down to 105. A lot of things going on in the
huge movements. It is.
Yeah.
I agree with what you're saying in terms of that, fear staying in there, right? That gold staying above there. And that's kind of what surprises me the most in terms of the market rebounding so strongly off of the lows last week, that I think that fear is still there, and it's remarkable you could get that charge back to higher prices when, like you're talking about, gold is telling you maybe there's fear. I mean, you got the 10-year at 1.69 handle, and then we have the likes of, you got Bank of America today, 1 in 3 chance of a recession. You have Goldman revising GDP down to 1.8% maybe, and we're back at almost all-time highs in the market, so we'll see. Stay tuned, folks. Basil and I coming right back.
If you're in the CD market and looking for a secure investment, the Tiger First Mortgage Program may work for you. The security for these first mortgages are building lots in the Tax Opportunity Zone in St. Petersburg, Florida. The Tax Act of 2018 set up tax-free zones across the country where you can build and hold for 10 years and pay no tax on the profits, which makes these lots valuable. The investment is anywhere from $30,000 to $75,000. The interest paid is 7% yearly, paid on a monthly basis. According to Bankrate.com, the best rate for a 4-year CD in the country as of February 20th is 3.1%. A $50,000 investment at a normal 4-year CD rate of 3.1% would give you income of $1,550 per year or $6,200 over the 4-year period. That same $50,000 investment in the Tiger First Mortgage Program would give you $3,500 per year or $14,000 over the 4 years. Which would you prefer, $6,200 or $14,000 of interest on your investment? If you would like more information about the Tiger First Mortgage Program, you can call me at 877-518-9190. That's 877-518-9190.
It's amazing to think that Tom O'Brien started his weekly gold report 17 years ago, with the first issue published April 7th, 2002, when gold was trading at under $300 per ounce. Gold peaked at more than $1,900 in 2011, and after spending many years consolidating at lower prices, gold may be poised for its next big run. Tom O'Brien publishes his weekly gold report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, South African rand, as well as 25 different mining equities with specific buy-sell recommendations. As of April 1st of this year, the Gold Report currently has 8 active positions with an average unrealized profit of almost 8% for each open trade. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your Gold Report subscription today, visit the front page of TFNN.com. Don't let gold's next big run pass you by. Sign up today. Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour. Next on TFNN.
Welcome back, folks. We're holding down the fort for Larry Pesavento this morning. I'm Tommy O'Brien, joined by our man Basil Chapman. Starting off the trading week, we got Dow futures down about 177. That's almost 0.7% in the red. S&P's down about 16. That's about 0.6. And NASDAQ negative by about 36 points or 0.5% in the red right now. So, Basil, we got the TNX. What are we looking at up here?
So look at the TNX. Look at the sharp move. This is from 32.48, there's 3.248% back in October of 2018. We went to the low just 3 days ago. I don't know if it was actually 1.6, must have been very close. One.
And just to bring people, this is an ETF corresponding to the 10-year yield, correct?
This is the the actual name is the TNX Daily CBOE 10-year Treasury note interest rate. It's just the rate itself.
The rate, okay, but as in price versus interest rate. So this is going to correlate to somewhat the rate or the yield of the 10-year. And as you can see, as those markets, as the yield has dropped, right? We've seen that, of course.
Just under 16, 1.6. I mean, that is a huge move in. I'm really talking not the fact that we've been here before. That's not the issue. It's the speed with which we've come down.
Sure.
And it is really what the Fed, because the Fed is, if you think about the Fed, in a way they stuck because they always base whatever they're doing on history. They don't really like to look forward. Whether they say they don't like to look forward, they say we're looking back and we're trying to extrapolate from that data. Are the parameters that we're always looking for, have they been hit? Is the data dependent? Is the data being touched in relative to the scale that we had or not? It's just real simple. But in reality, there are so many other things that they have to think of. So, and the Fed's never really been there. I mean, not since I think in the 1920s have we seen something like this.
Yeah.
So they are really stuck. And the market is saying, we don't really have confidence that the Fed is going to make the right move, but we also don't know what they're doing right now. So I think that's part of the whole picture, that it is, it's an international tidal wave of lower rates. And how do you change that? The United States very often is a leader in certain things. I don't know if they can lead by, let's just say the data comes in over the next 2 months. I don't know if it will, but I'm just saying, imagine if it came in and was just good enough to keep the data to the point where they're saying, we should actually be raising rates, but we can't do that. What a dilemma.
Right? I know. The whole thing is pretty perplexing in terms of where we are in jobs, where we are in the market being so close to highs. Now, we have some serious volatility. And then you talk about the prospect of multiple rate cuts. You talk about the prospect of, we're at a 1.6 something yield. And I mean...
And any traditional economist that I can think of has had to be saying to themselves, I have never in all my life seen markets at almost all-time highs or having just reached all-time highs, and here we are talking about cutting rates.
Yeah.
And you've got around the world, you've got certain bonds that are yielding a negative yield.
Negative everywhere, right?
So-
it is remarkable, man. And, you know, the jobless, so I'm just going to tell you, I mean, the two of the stories kind of coming out today that's interesting. We'll just pull it up real quick. I have it in terms of, so you have Goldman Sachs, and I touched on it briefly. So they lower their forecasts from 2% GDP down to 1.8%, citing a larger than expected impact of the recent trade war events, okay? So you got that going on, but then on the heels of that, you also have a note, let's get it up here, from Bank of America, and they come out this morning and say that there is now a 1 in 3 chance of a recession in the next 12 months. What's interesting here is that they had been putting it at about 20%, okay? And then the quote is, so this is a note sent out to clients from their global economist. So their official model has the probability of a recession over the next 12 months only pegged at 20%, but our subjective call based on the slew of data and events led us to believe it is closer to a 1 in 3. I mean, folks, it looks marginal, but you go from a 0.2% chance or a 20% chance to a 33% chance, you're talking about, that's almost a 66% increase, as in you go from a 20% to a 33% chance. That's a huge increase percentage-wise, and the fact that they are pointing to it, and you have Goldman coming out and saying that they're pulling back their GDP, you combine that with what the market did last week, you combine that with gold being above 15.15, you combine that with the 10-year being at 1.69%, that's a scary, and you combine it with China trade talks, the escalation of things, and then you have the Hong Kong protests, and hopefully that, for the benefit of everyone over there and just the trade, doesn't escalate. And, you know, it's remarkable to try and imagine where we'll be in 12 months, let alone, Basil, you add on to that, we have an election in 15 months that it seems like the rhetoric just keeps ramping up, and how that will play into any type of calmness for the markets and returning to any sense of norm. I don't know how that plays out as well.
But you also have to put it into the aspect that President Trump has made the stock market his baby. No president has ever claimed it as his own personal emblem.
Probably for good reason, but that's a different conversation. Go ahead.
Right. I mean, it's you know, I always say there's hubris in the market, and you don't think that any one person can have that kind of influence. The market always proves that person wrong.
Yes.
So I'm a little concerned about that. At the same time, the monthly charts are still really strong, and I still see new highs coming.
Yeah.
But I must say, we need to get through this difficult period right now on a purely technical basis. I don't care really about
I was just going to add to
fundamentals.
that the other reason you don't see presidents taking claim for it is because the other thing is that the Dow Jones Industrial Average does not correlate to the wealth and benefit of the citizens of the country. As in, you know, you take a company like Boeing alone, the amount of points that they put into the Dow on the run-up is staggering. You're talking about thousands and thousands of points just from Boeing's run alone. When is that really a transition to the, you know, wealth of the economy and so forth? So even though we're at highs, and, you know, even though that jobless number, Basil, just remarkable, right? I mean, if you want a job, you can go get a job. But what kind of job are you getting out there? That is the question as well, right? As you have, you know, unions going away, pensions no longer existing, and the kind of gig economy, as in, yeah, you can go out and you can always, anybody right now can become an Uber driver. Anybody can become a Lyft driver. But is that going to provide you with the income and the benefits that will allow you to be, you know, an avid contributor to the economy? That's a completely different story as we see a jobless number that continues to decline, but raising income levels, just stagnant wages, you know, and so how that plays into the whole.
Although the last readings have shown that hourly wages and wages in general have actually risen, but hasn't risen as much. You know, they don't measure inflation, but anyone who's been to a supermarket has noticed over the last year or two, prices on almost everything have gone up.
And wages and jobless numbers have been low for so long, and the wages have been stagnant for so long that the catch-up there seems like it has a long way to go before that kind of correlates to what would make sense in any type of semblance to how we used to interpret things, you know, in terms of a jobless number, where basically full employment, and we're now just marginally getting some wage increases, but even then you point to, well, that's great, but we got inflation as well. And then we're going to get some tariffs, and this round of tariffs, consumer goods going to get hit. We'll see how that plays out. Folks, we're going to finish up. Give us a call, 877-927-6648. Basil and I will be right back to wrap up this program.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Folks, welcome back. Tommy O'Brien with Basil Chapman filling in for Larry Pesavento this morning. Folks, you're hearing Basil, all this great commentary. Check out the opening call on the front page of TFNN. Give him a quick plug out here. I know, Basil, you had a great update for your subscribers on Saturday. You had one as well on Sunday. And, of course, you had one as well this morning. Right on the front page of TFNN, the opening call. Check it out, and you'll get access to all Basil's charts. A bunch of great archive webinars Basil has up there as well. And I know we're going to be talking about another webinar coming up, Basil, but we'll talk about those details when we publish them for all. But getting back to the market, how about oil, Basil, man? Quite a volatile morning. We had oil trade to 53.60, and boom, just in a heartbeat, from about 6:30 in the morning up until now, we're up more than about $1.50. You got crude back above $55.
So there's a range, and I had drawn this in some time ago. You can see in this middle chart, the weekly chart, I drew this big rectangle, and as I said, rectangle formation is going to last a lot longer than your patience.
Right.
But what is also important is that there's an H pattern, lowercase h pattern, and it broke fractionally under the left side low, that was made back, I think it was in May, somewhere around, May, and we went under it for a moment about 4 days ago, then closed above it. So now it's very important because it says having gone lower, you can rally, but you're probably going to rally only to the next either peak or moving average of importance, and that makes the 56, I'd call it the 5620s to the 5680s as really important resistance.
Okay.
A close above that says you can go all the way to the peak that was made. Oh, I'm having trouble with this. Right there, 5870. So the whole area of the 56s is going to be important. If it can break above that, that is so great. You can get back into that trading range that was made between 56 and 58.5. That's going to be important. From the lower lows and lower highs, this says to me probably just a bounce in crude oil, but of course it's an international. It's like gold.
Definitely.
It's black gold because it's oil. So anything can happen. So we don't know what's going to happen overseas, but at this particular point, the chart still says it's just stuck in a range. It has these big moves, but then it stalls out, both upside and downside. So I've got the trading band that's important.
Okay. Basil, always a pleasure, man. Thanks so much for filling in. And, of course, we look forward to the Tiger Technicians Hour at noon.
Thank you very much, Tom.
Thank you, man. Folks, stay tuned. I'm going to be coming back at 10 o'clock with Tom. Of course, Fast Market at 11, Basil Chapman at noon, Steve Rhodes, Dave White, Tom O'Brien all this afternoon. Stay tuned, folks. Have a great Monday.